Vanakkam. Today we are going to see another very interesting topic, and this is going to be the base for all types of frauds. It has happened not only in banks, in all types of the industries or trade and everything, but we are going to discuss all the red flag accounts which have been announced by the OBI, and this has been given very much importance towards the reporting of fraud. We are going to discuss this in detail, and this is going to be definitely this is going to change the entire Indian economy or entire bank industry. But everything has to be done only with the help of the chartered accountants. So let us go and have a depth study of red flag accounts. Why the concept of red flag account is being introduced in the Indian economy? Nowadays, the fraud has started to increase in all kinds of trade, bank, and everything. So, in order to identify the area where the fraud has taken place, this concept of red flag account comes into the picture. And it is there in all the types of general trade as well as in the loan portfolios of the banks. So we are going to have discussion only from the bank audit angle, and I'm not going to discuss with the other angle also. But red flag account means it's a basic thing. So incidents of fraud has started to increase general and loan portfolio. So for this only, for these two purposes, the concept of red flag account has come to the picture. And what are the stages of the fraud? So there are three stages of the fraud. So this I have defined. And early warning signal person, first stage. And second stage, this early warning signal person, if it is there in the bank, then it will be converted into red flag account. After analyzing the red flag account, the final decision of bank fraud comes into the picture. So we can say early warning signal person, early warning signal is nothing but the raw material, and red flag account we can say as the work in progress, and bank frauds is the finished product. So just for easy understanding, I have given this. So red early warning signal and red flag accounts and bank frauds. Here I want to say a very, very important thing. All the chartered accountants who are going for the bank audit are called as early warning signal person. This is a very, very important term. We are called as, all the chartered accountants have to be called as early warning signal person. So you have to be very, very careful, because whenever there is any mistake has taken place or any wrong thing has taken place, you are doing the audit, you are the person who has to report it. So you are called as early warning signal person. From where this red flag account applicable, or where we can find this red flag account, or from when we have to find this red flag account? This you can find from concurrent audit, stock audit, statutory audit, credit audit, revenue audit, or any type of audit, any type of bank audit, you can find the red flag account. That means all the audits, from all the audits, whenever you are going for the audit, you can find the importance of red flag account. And this is a LFAR requirement. Say in long form audit report, it's a compulsory requirement. And every chartered accountant who are doing the statutory audit, they have to give the red flag account identification. They say that the red flag account concept was introduced by RBI to get the banks to act on early warning signal person. Here, they say that this includes raids by the regulatory and tax authorities. So that means if there is any raid as conducted by the regulatory and tax authorities, then all those accounts will definitely come under the category of red flag account. Once an account is identified as red flag, then a forensic audit has to be conducted for that customer, and it's a mandatory, and this forensic audit has to be completed within the period of 6 months in order to decide whether that activity is a fraudulent or not. So red flag account is just a work in process. That's why I said so, work in process. So when you go and do the investigation through the forensic audit, if you find there is no fraud, so you can leave it. Otherwise, if it is a fraud, then you have to report the same. So this is the highlight of red flag account. That is, you have to identify red flag account. That is even including the rates rates by the regulatory authorities and tax authorities also form the base for the red flag account. Next one is the banks, they have to complete the forensic audit within 6 months of the happening in order to identify whether that red flag account leads to fraud or not. So this is a basic thing that we have to remember with reference to red flag. And the objective of framework, what is the objective? That is, in order to prevent the fraud, we have to do this exercise, and early detection will definitely solve a lot of problems. And if there is any fraud, this has to be reported to the Reserve Bank of India. And if there is any fraud, then that has to be conducted. The fraud inquiries have to be conducted by the investigation agencies. And after the conducting the investigation, then staff are accountable. So the staff accountability is also being fixed because of this exercise of identification of loan frauds. Then what is the auditor's role? What RBI views on auditors towards non-detection of fraud? So there's a fraud. But if an auditor is not able to identify the fraud, then what the RBI said, if there is any fraud undetected during the course of audit, then the auditor is held personally responsible for the loss to the bank. They say that it's a personally responsible for the loss to the bank, apart from losing your certificate, facing institute action, RBI action, all regulatory actions, even the bank action also. So you have to be very, very careful if there is a fraud. So non-detection of fraud will definitely make the auditor as a party to the fraud, and his properties will also be attached. So this is a very, very important area. So please be careful whenever you are doing the audit. So how to reduce a loss and fraud? So if you detect it early, then there will not be any future loss. There will not be any future loss, or the loss will be reduced. Suppose if we fail to identify the fraud, then the fraud continues. And if you do the necessary corrective action, definitely there will be scope for the frauds to come down. Next area is why the RBI has given importance for red flag account. Because it is an important step in the fraud risk control. And if there is any suspicious fraudulent activity, this can be identified through early warning signal. So the RBI has given a very big list of EWS, that is early warning signal, we will see later. So this suspicious fraudulent activity will be identified through the early warning signal, and this will definitely put the bank on alert, that is warning towards fraud. Yes, that's a fraud which is going to happen. So please be careful. So red flag account definitely leads the bank to be on alert to carry out the transaction. What is the threshold of red flag? So whether it is a mandatory. So the RBI has come out with the mandatory exercise of red flag account for the loans sanction of 50 crores and above, and irrespective of the lending. So whether it's a sole financing or multiple financing or consortium banking. Suppose even if it is done through two banks, say one bank has given 30 lakhs, one other bank has given 30 lakhs, so it amounts to 60 lakhs. So for both the banks together, if the limit cross 50 crores, then the red flag account activity must be carried out. It's a mandatory to be done by the bankers. And even the bankers have got the option, even if the limit is below 50 crores, there also the bankers, based on the bank's policy, they can direct the auditors or chartered accountants to carry out the red flag account activities. Even they instruct the top officials to carry out the red flag account activities. And what's the reporting requirement? Then if there is any, it's a mandatory. So after exercising the RFA, red flag account, then those reports have to be submitted to the Reserve Bank of India. And if it is more than the threshold limit, what is the threshold limit? It is 50 crores and above. Then report to CRILIC is very much important. That is Central Repository of Information on Large Credits. That is a must also. Then in case if there is any fraud, then report all frauds to Central Fraud Monitoring Cell Department of Banking Supervision, Reserve Bank of India, Bangalore. So this is a must thing. So if there is any fraud in banks, and if this has been found out through RFA, then the reporting to Central Fraud Monitoring Cell for Department of Banking Supervision of RBI, Bangalore is a must one. Then auditor has to verify all the reports. So the burden of auditor is huge. So you have to verify all those reports which have been submitted to Reserve Bank of India. And what are the tracking? So it is how to track the early warning signal. It is not an additional thing. It's merged. So it's an ongoing process. It's a continuous activity. Whenever you are exercising the credit monitoring role, you can find this early warning signal, and it acts as a trigger. Suppose if anything goes wrong, so you can find through this. So it acts as a trigger for any possible credit impairment. And this or early warning signal, it plays a middle role between the credit risk and the fraud risk. So credit risk is sanctioning of the loan, and fraud risk is the in between that. The EWS is that as early warning signal is that, then that is being followed by red flag account. Then the fraud risk comes into the picture. Yes, a chartered accountant or those persons who are doing the red flag account exercise, he has to study the annual report as a whole. He should not read the annual report on piecemeal basis. That is not, he has to read everything. Not merely reading the or merely studying the financial statements, board report, and management discussion and analyzing the statement are not sufficient. He has to read the annual report fully, and particularly the study has to be conducted in relation to related party transactions which have been clearly mentioned in the note of the accounts. That's a very, very important thing. Then who has to report or to whom you have to report? So Credit Fraud Monitoring Group, they have to report the details of, because it's a mandatory of 50 crores and above loans, and they have to give a specific report that there is an early warning signal observed or not. So fraud monitoring group, they have to report the details. Then this report has to be given to CMD or CEO every month. This report has to be given to CMD or CEO every month. And this report of RFA has to be reported to special committee of the board for monitoring and follow-up of frauds. This is regarding the remedial action to be taken along with the current status. What is the current status? That also you have to discuss it. And in case if there is any delay in early detection of the fraud or delay in early identification of early warning signal, then what is the reaction? So if that fraud detection takes long time, then banks say that banks have to report that those advances as fraud when they exhaust the chance of further recovery. So fraud is there, and if there is a delay in reporting the fraud, then all the sources of the recovery, all the chances of the recovery towards the fraud will be lost. So early detection is very much important. And if you failed to identify the fraud, if there is no early detection of the fraud, then the borrowers or the persons who are doing the fraud, they try to commit the same type of fraud. And another thing is it delays the action against the unscrupulous borrower. In case if there is any fraud and if there is any delay in detection of fraud, then definitely action against the unscrupulous borrower will be delayed, and it increases a loss to the bank. So this is a very, very basic thing. So early detection is must, otherwise it will definitely increase the loss to the bank. So this will be strengthened through the monitoring process. So early warning, delay in early detection will definitely lead to a lot of problems. So this has to be conducted immediately. Now, there are three methods. There are three methods wherein the checks of investigation loans are, we can say the checks or investigation during the loan life cycle Everything has to be conducted from the early warning signal or red flag account, or is there any fraud or not? There are three stages. One is pre-sanction, second one is disbursement, third one is annual review. So we are going to see for each and every point separately: pre-sanction, disbursement, annual review. Now we are going to see the pre-sanction points. So independent information market intelligence of the borrower have to be collected by the banker before the sanction of the loan. Next one is whether the borrower has involved in any legal dispute with any of the officers, any of the persons. So the legal status of the borrower has also to be inquired. So is there any legal dispute? Third one is if there any raid conducted by the government, those details have also to be analyzed by the banker before disbursement of the loan. And another thing is if there is any strictures passed against the borrower by the government, suppose if the government wants or if the government penalizes a borrower, then those types of strictures should also be inquired by the bankers before the sanction of the loan. So then the banker during the process or during when they prepare the process note, they have to see whether their name is there in the list of the RBI. That is whether their name is in the defaulter list of RBI, ROC, and other government agencies. This has to be confirmed by the bank. Next one is whether this borrower has been included in the willful defaulter list or fraudulent person list. This also the bankers they have to consider. And now loan is sanctioned. Now they are going to disperse. What are the cautions that they have to take? Whether the borrower has adhered to the terms and conditions of the sanction. If there is any dilution in the terms and conditions of the sanction, that has to be inquired and reported by the risk management group to the sanctioning authority immediately. So adherence to the sanction, adherence to the terms and conditions of the sanction must be there. If there is any dilution of the terms, then risk management group has to report this dilution to the uh, sanctioning authority immediately. Now we are going for the annual review of the loans. So annual review, you are whenever you are carrying out the annual review of the loans sanctioned for 50 crores or above, because the threshold limit is 50 crores and above. So it has to be studied from the fraud angle. Here I want to say one very important thing. If there is any fund diversion, there is any diversion of funds, then it amounts to fraud as per the RBI view. So you have to see that, and particularly the chartered accountants have to give a specific report that there is no diversion of funds. And the stock statement submitted by the party is regular and good in nature, and there is no stress in the group accounts. Next one is what is the development of the client in the market. So the bankers, they have to track the market development of their client. It is not only the sanction of the loan. After sanctioning the loan, the banker, they have to follow the customer, whether the customer is doing the business in a good manner or not, whether they are deviating from the regular business norms or not, everything they have to see. Then the stock market movements. Suppose if it's a listed company, then what about the stock market movement? So that also the uh, auditor has to see. Then study not confined only to the borrower, but as a group. So whenever this fraud study has been conducted, it is not restricted only to that particular borrower. As a group, the study has to be carried out. So here, in order to avoid the fraud, the lot of encouragement should be given to the staff, and every time whenever the management they calls the employees for discussion, they have to give their support, they have to give their views, and those employees who are giving negative about anything about the unit or about any person, the staff must be protected as per the whistleblower policy of the RBI. So it has the staff has to be given protection. Then fraud monitoring group has to hear the views of the employees. Suppose is there any fraud or not? Then fraud monitoring group he has to hear the views of the employees, and staff accountability has also to be fixed. And what is the role of the auditor? So any finding, if it is there, then the auditor has to report to the top management and including the report to audit committee board. And even we can say that if any auditor is being appointed to do any specific work, then as per the direction given in the appointment letter, the auditor has to report. So even the auditor can recommend the management to conduct the forensic audit. This is a very, very important thing. So the auditor has got the power to recommend the power to recommend the management to conduct the forensic audit from red flag account angle. So this is the main role of the auditor. What are the other highlights? So if there is any warning, early warning signal activities are there, if any loan is being identified as red flag account, no further loan will be sanctioned. So it is a role of the auditor to confirm that those accounts have not come under the category of red flag account or early warning signal. And it's a responsibility of the bank to classify one account as RFA or fraud status. So the red flag account status or fraud status, it has to be classified by the banker. It is the banker's responsibility. And if there is any fraud, then it is a responsibility of the bankers. They have to make the compliant with the law enforcement authorities. Say in India, it is CBI, including the police. CBI as well as police, they have to make the complaint. And they have to fix, that is bankers, they have to fix the responsibility irrespective of the status of the staff, whether it's a peon, whether it's a scale 1 manager or scale 2 manager, whether it's a GM, for everyone, if there is any fraud, then the responsibility has to be fixed by the bank. Then bank, in case if they identify the fraud, then those frauds have to be classified into two parts. One is vigilance related fraud and non-vigilance related fraud. If the fraud is related to vigilance cases, then this has to be referred to the investigation authorities, say CBI or police. And if it is a non-vigilance cases, then it has to be dealt only by the bank level, and the entire process has to be completed within a period of 6 months. That is why in LFA long form audit report, they say that whether the reporting has to be done by the banker to the head office, and whether the latest steps taken by the management is not known to the branch. So this is also one of the conditions in long form audit report. Anyhow, for vigilance case, refer to the investigation agencies. For non-vigilance case, it has to be dealt at the bank level, and the entire case has to be disposed of within a period of 6 months. Then in case if there is any person has been identified as willful defaulter, then all the penal provisions are applicable. Because he is also treated as the fraudulent person. Then borrower defaulted and committed fraud but not eligible to get loan from financial institutions, NBFC and others for a period of 5 years. Suppose if any borrower has been identified and defaulted, committed any fraud, then he will not be sanctioned any loan by any banks for a period of 5 years. This is a very, very important thing. So if you are in practice, please observe this point. Then all the directors, including the whole-time directors, are liable to face the penal provisions. And if an account is been identified as red flag account or fraud account, no restructuring is allowed, and there should not be any grant of additional facilities to these red flag accounts. And even one-time settlement account is a one-time settlement is also not allowed for this red flag accounts or fraud accounts. And this is a early warning signal given by the Reserve Bank. It's a very big list. Almost 40 activities are there. We will have, wherever possible, we'll have deep discussion. Otherwise, I'll just touch the point. Default in payment to banks. Suppose if a borrower is there, he has made a default to the bank, then the bankers have to think why the party has not repaid the loan. So they have to probe into the business activities of the borrowers. And if there is a default in making the sundry debtor payments or other statutory bodies, why this there is a sundry creditors, it is a sundry creditors. Why the sundry creditors why sundry debtors have not been paid, why sundry creditors have not been paid, why the party has not paid the statutory dues. All this, the bankers have to treat it as early warning signal. So I said it's a raw material, it's a basic thing. So default in payment to banks and creditors, this is one of the reason. And bouncing of high value checks, the party has issued checks. All those checks have been bounced frequently. Then the branch manager or banker, they have to think that, or they have to take the decision that this party is got some financial problem. So if the checks have been bounced, so yeah, care has to be taken. So please refer the check return register. And if there is any raid conducted by the income tax authorities, GST authorities, FEMA authorities, regulatory authorities, then the auditor has to see the reasons for those rights and has to see the latest position. So these will definitely make the concern to have good. There is a problem to run these units if they have faced the rates. So this is also another early warning signal identified by the RBI. And frequent change in scope of the project. So now I want to start a project. Now I have applied. Suddenly I change the project. Again I change the project. So frequent change in the scope of the project, if it is there after getting the loan, then this will also lead to RFA. That is early warning signal. And if stock is underinsured or overinsured. Why the stock is underinsured? Why the stock is overinsured? This is also another early warning signal. If that is there, then those units must be watched by the bankers very carefully. And the bankers, they have to assume or assure that the invoices submitted by the borrower to the banker to raise any loan should be a genuine one. And if they find that those invoices are fabricated one, then the intention of the borrower is very clear. So there's a there will be chance for fraud. So if there is any fabricated invoices, that also they have to report it. Then dispute on the title of the collateral securities after the receipt of the loan. And if there is any dispute that has found in future by the bankers, then those type of dispute related to the collateral securities title deed will definitely, it's a early warning signal because it is very difficult for the bankers to recover the amount if the title deed is in dispute. So this is also another early warning signal. Why the title deed dispute was there? Why this has not been informed to the bankers? All this, the borrower has to give explanation. And if there is any wide variation in costing of the project, that is, after at the time of giving the project, they say that it is 100 crores. But when they implement, it comes to 45 crores. Why the project cost has been unnecessarily increased? That also you have to inquire. So wide variation in the costing. Suppose if it is 100 crores, the cost comes to 145 crores, then that will put a lot of strain to the borrower because the remaining 45 crores, the borrower has to borrow from outside. So this is also another base for the red flag account. And funds coming from other banks to liquidate the outstanding loan. So there's an account because if the borrower has availed more than 5 crores loan from other bank, he is not supposed to open another account with the other bank. But if the funds have come, one bank has got the loan, but other bank is giving the fund to liquidate the outstanding loan. So that means whether the borrower has availed the loan from two banks or not, or three banks or not, from that angle also, the inquiry has to be conducted by the auditors. And the foreign bills have not been paid for a long time. So the auditor has to assume, is there any hawala or not? That also he has to confirm. Next area of early warning signal is that there is a very tough class to execute or to issue bank guarantee LC or standby LC. If that is there, on reading the terms and conditions of BGLC or standby, so one can say that if they are not able to implement the BG, then bankers' funds are in strain. So it's also to be treated as early warning signal. And I don't want to inform about from the person to whom from whom I am going to import. If that is the bankers, they have sanctioned the import LC, but the borrower is not ready to import, ready to inform about the details of the import leg. So that is, even we can say that if the borrower is not ready to convey the information about the buyer or seller, it is also another base for the early warning signal. And the manager, he wants to go for the inspection, but the request has come from the borrower, sir, please don't come. You come after some 2 days or 3 days. I am going out because my borrower has come to the unit. My supplier has come to the unit. So we are going to have discussion. So this will spoil the name. So with some flimsy reason, they postpone the good on inspection. So this is also another base for the bankers to see as the early warning signal. And delay observed in payment of outstanding dues. The outstanding dues, or we can say creditors, that is that there is a delay in making the payment. So that means why those payments have not been paid on time. And other area is financing the unit which is far away from the branch. Suppose if the banks, they finance a unit, say some 50 kilometers away from the branch location, then these type of sanctioning of the loan for the units which are far away from the branches will definitely create a scope of lot of fraud. So it is also another early warning signal. So one person has to be very, very careful whether the unit is nearby, and if it is beyond the reach of the branch location, say 40 kilometers or 35 kilometers, it is very difficult for everyone to go and do the inspection. So double financing is also possible because the unit, they are well known the facts that the bankers, they will not come for the inspection, so they will approach another bank also for the same stock. They can identify, they can avail two loans also. So double financing of the for the same stock will also be there. Possibilities are there. Then client not acquired as debts are high. Debt is high, but the client has said that no, 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 we will not acknowledge. Say the person say that this party has to pay 2 crores to me, but the bankers, they used to ask for the confirmation of the debt. When that party is not ready to give the acknowledgement of debt, then that is also why that party has not given the acknowledgement. So this also to be treated as the early warning signal. Another area is frequent. So you have got the bank guarantee, but frequently the beneficiaries invoke the bank guarantee. So that means the borrower has not fulfilled the terms and conditions towards the execution of any contract. So frequent invocation of BG. So you please go and refer the bank guarantee register. You can see whether the bank guarantee is being invoked frequently or not. If there is any frequent invocation of bank guarantee, then this will be treated as the early warning signal. Next area is the party has got a loan. So he has got another loan to have for the regular function. So funding of interest, that is, I've got to pay the interest to the banker. So I got another loan to close or to pay the interest. That is, to pay the interest, I've got additional loan. If that is there, if that is being watched by the bankers, if that is being watched by the auditors, it is also to be treated as early warning signal. And few parties, they offer the same collateral to various lenders. So this you can identify from the encumbrance certificate. If that is there, because the bankers, they have given the loan based on one collateral security, and if that is if the same collateral security is being given to another customers, another bankers, then it will be treated as the early warning signal. Next area is the parties has concealed the vital document. So that's a master agreement. He has not produced the same thing to the banker. That's a insurance coverage is there. Those details also not covered, not informed by the borrower to the banker. So concealment of vital documents. If that is there, if it is found in future, the bankers can say that it's an early warning signal. Next area is that is diversion of funds, that is floating front and associate companies by investing borrowed money. So you have got a money from the bank, and based on the funds received from the loan funds received from the banker, this borrower has floated as an associated concern, because for the associated concern he wanted the capital. He has diverted the money from the parent company to the associate companies. So any diversion of funds to the associate company will also lead to fraud. So this is also another indication for the early warning signal. Suddenly, the promoter's capital portion or stake has started to reduce. Initially, he has invested around 80%. Suddenly, he started to liquidate the capital without the getting the prior permission of the banker. Even if they apply for the prior permission, it's a clear indication that this promoter is going out of the business soon. So this reduction in state of the promoter should also be viewed as the early warning signal. Next one is suddenly the key personnel, they have resigned from the job. He is always looking after the company, but suddenly he has resigned. Why he has resigned? These things have to be inquired by the bankers. These things are also the base for the EWS, that is early warning signal. And there is a frequent change in the management that also will be treated as the early warning signal. So for each and every point, we can have 1 hour discussion, but I'm just touching those points. Suddenly, number two transaction has started to increase because transactions are there, but those transactions have not been billed. So if in every year it started to increase, that means the party is not ready to carry out the entire transaction in white. So this is also another early warning signal that this party may commit fraud in future. So there is a large transaction that took place between the interconnected companies, and A company is there, B company is a sister company, and A company has got a loan from the bank, and all the loan amounts have been transferred to B company, and it was a long pending, money has not come. All this lead to early warning signal. Next area is the stock has gone out, but to that extent, when stock has gone out, to that extent, sales has to increase. But now, stock has gone out, but there is no increase in sales. That means the party has sold the stock in number two. So, in case if you identify this type of disproportionate growth in the turnover, then that will be treated as early warning signal. That is why in stock statement, the bankers insist opening balance, add purchases, less sales, less cost of the sales, then comes to closing stock. But most of the borrowers, they never fill the entire column. They give only the final stock, that is closing stock. So if that is there, then the auditor can come to the conclusion, or the bankers, they come to the conclusion that is an early warning signal. Then significant movement in receivables, disproportionate higher growth. So it is very, very simple. I can explain this point in a very simple manner. Sales is only 20 crores, whereas debtor portion is 60 crores. That means without sales, the debtors portion is there. That means there is a debtors have not been recovered for more than 1 year. So if that is there, we have to study the debtor life. What is the debtor's life? That we have to see whether is there any possibilities of the debtor for the for the amounts to be recovered. This point you have to see. So increase in debtors without corresponding increase in sales, that also will be treated as the early warning signal. Then suddenly there is a disproportionate increase in current asset. Suddenly cash has come. Suddenly stock has increased. Suddenly debtor portion has increased. So there is a, but to that extent, there is creditors has not increased. To that extent, capital has not increased. So disproportionate increase in current accounts will also to be treated as the early warning signal. So significant increase in the working capital when related to turnover. Normally, as per the NOI committee report, if the loan amount is 1 crore, the turnover should be 5 crores. But I want working capital. I want to increase the working capital, say from 1 crore to 2 crores. That means my turnover should be only, it should be 10 crores, but I've got only 4 crores. That means the working capital portion loan has been increased, but there is no subsequent increase in the turnover. So this may lead the portion of the fund diversion. So that point also you have to see. And critical issues highlighted in the stock audit report. So as an auditor, as a banker, you have to go through each and every point of stock audit. What's the observation given by the stock auditor that you have to see? This is also another early warning signal. Increase in fixed asset, but without corresponding increase in turnover. That is fund diversion is there. So suddenly fixed asset has increased, but turnover has not increased. But for the entire project, the loan has been attained. So this also will be treated as a early warning signal. Increase in borrowing despite huge cash and cash equivalents in the borrower balance. Normally, this you can see from all the balance sheet. Huge cash of 2 crores are there, but the party has gone to the bank and he has got the loan. Sir, I need another 50 lakhs as loan. So cash is there. So without utilizing the cash, suddenly the credit has started to increase. That is, loan amount has started to increase. This is also another reason to be treated as early warning signal. And on ROC, there is a search report. Register of company's search report. Liabilities are there, but that is not covered by the auditor, but is not covered by the borrower in the annual report. That means why the borrower has hidden the liabilities. So that point also you have to see as a early warning signal. And substantial related party transaction. If the auditor or the banker feel or observe any substantial related party transactions, that is also another point of EWS. So material discrepancies reported in the annual report, and there is a significant inconsistencies in the and within the annual report. If everything is noticed, then that is also another very important point to be covered under the early warning signal. Next one is poor disclosure of materiality adverse information, no qualification by the auditors. That is, there's an adverse nature, but the auditor is not ready to qualify, or there is no qualification at all. So poor disclosure is noticed by the bankers, and there is no proper disclosure by the statutory auditors. Then that is also to be treated as the one of the reasons for the early warning signal. Then frequent change in the accounting period or accounting policies. Now it is not possible because the government has said that it is only the financial year you have to consider and not the calendar year. So if there is any change in financial year to calendar year to again financial year, these types of change in accounting period, then that will also be lead to the early warning signal. So I need loan. Frequent request by the borrower. Normally, one borrower has got the tendency, he will always go to the bank. Sir, I know, I need loan, I know loan. So if they say that frequent request for the general purpose, sir, I want a personal loan. If they ask this, then the bankers, they will definitely take a decision that this party is in financial trouble. We have given the huge amount as loan. What will happen to our loan? So this is also another early warning signal thing. Then movement of account from one bank to another bank. So that is nothing but takeover of the loan. So one from say a borrower has borrowed a loan from A. Suddenly after the receipt of the loan, within a period of 3 months, this loan is being transferred to B bank, then from B bank to C bank. So frequent movement from one bank to another bank. That is takeover concept. So you have to see if there is any takeover in the loan, you have to view everything from the early warning signal. And frequently, this party will ask for the ad hoc loans. Sir, I need 10 lakhs immediately because I've already availed 20 crores or 2 crores. I need 10 lakhs. Normally, now the bankers, they have come out with a solution for this that once in a quarter, they will give only once. And this ad hoc loan has to be closed within a period of 45 days or 60 days based on the bank's policy. If the party has gone to the banker and they want ad hoc loans regularly, then there is a clear indication that the party is having some financial problem. So, or something where he has diverted the funds. So, this frequent adequate sanctions must also be inquired into. and the borrower has not routed the entire transaction through the account. So this you can easily identify. Go to the sales and you just see what is the total sales less data sales. So that is a net cash and uh, check transactions through the sale. To that extent, the money has to come to the credit side of the cash credit account. Say if the sales, cash sales is say 20 crores, then the sufficient credit, say if the amount should be, if the amount is only 2 crores, that means for the 18 crores, the money has not come into the bank. So the entire sale process, if it has not routed through the bank, it is also to be called as early warning signal. And LCs are issued for local trade or related party transactions. Normally, LCs have to be issued only for the import of goods from abroad. If the LCs have been issued for the local trade, that is also import. I mean, inland LC is also possible. But if it is issued for the related party transactions, even for the local trade also, you have to be very, very careful. It's a clear indication that it is going to be an early warning signal. And huge value of RTGS has been done to the unrelated parties. He is not related to the business. Suddenly, yes, he is sending some 50 lakhs to some A customer, 50 lakhs to B person or C person. So that's a clear indication why this party is transferring the money through RTGS who was not related to the business. So this point also you have to verify. And another very important thing is heavy cash withdrawal is noticed from the loan account. See, from the loan account, the money has to be paid on check or maybe in the form of RTGS. Instead, if he has withdrawn the money in cash, those transactions also you have to anchor very carefully because heavy withdrawals from the loan account may lead or you can treat that as a base for the early warning signal. And if the party has submitted the invoice quotation, the bankers have sanctioned the loan, but if the original bills have not been produced by the borrower to the banker, it is also a clear indication that there will be some fabricated invoice or there will be some problem for the party to obtain the invoice or there will be some problem to to install the machinery or not. So non-submission of the original bills also lead to EWS, early warning signal. So what we has clearly said, all these 46 uh, early warning signal, if you the bankers they go through this thing and if they identified anything as fraud, then they have to identify those accounts from the red flag account. And after you identify one account as red flag, then a forensic audit has to be conducted within a period of 6 months from the original date of identification of red flag account. Then that red flag account, the after conducting the forensic audit, then the forensic auditor has to report whether it's a fraud or not. So this is the basic 46 early warning signal is being given. It's only they say that it's only selective, and the list you cannot restrict. So the list towards the early warning signal to identify the red flag account, the list goes on, goes on, goes on. And thank you, friends, for watching this program. And I'm very, very happy that I shared a lot of views on the red flag account. Even I can say for each and every red flag, each and every early warning signal person, we can discuss for more than 30 to 35 minutes, even for an hour also we can have discussion. Anyhow, I've just touched those points. Please be careful when you identify when you noted this early warning signal during your bank audit. I wish you a very, very all the best because with the only one caution, I want to close the session. If any fraud is undetected during the course of audit, then the auditor is held personally responsible for the loss to the bank, apart from facing our institute action, court action, regulatory action, etc., etc. So please do the audit very carefully and please identify if the early warning signal correctly, which is called as raw material. Red flag account is nothing but work in process. Then the finished product is fraudulent treatment. And thank you very much for the patient hearing. Nandri, Vanakkam.